Welcome to the Commercial Real Estate Show, your source for insightful analysis and enlightening discussions. Hello, I'm Michael Bull. Thanks for being with us. Today we're going to talk about the U.S. office market. We'll begin with an update from CoStar about the market performance and what to expect moving forward. Then we'll talk to the guys at Seven Oaks and see what's really happening on the ground, including a new development. And then we'll talk to Paul Zeman, who sells medical office buildings, and get a look at the investment market there. Well, please welcome Walter Page. He's Director of Research with the CoStar Group. Join us on Skype. Walter, good morning. Thanks for joining us.
Good morning.
We appreciate you being with us here on Skype today. And so, Walter, how did the office market perform in the first quarter, and how does it compare to last year?
I would say it's a mixed signals market. On a sales perspective, it did exceptionally well, but on the fundamental side, we had a slowdown, a significant slowdown. In fact, for the first time since the recession ended, we had less net absorption than we had completions. We had 12 million square feet of net absorption in the first quarter. It was down from 32 million square feet in the fourth quarter of 2014. Now, in some respect, I think that we borrowed from the first quarter to feed the outstanding numbers that happened in the end of the year. So we'll see what happens going forward, but that was definitely a slowdown. Despite that slowdown, the vacancy rates held constant at 11.3, and we reached a new high in terms of rent growth for this part of the recovery. We're at 3.8% on a nationwide basis. So it's a mixed bag, but it's still okay.
Well, it's interesting that we had that much rate growth. And was that in A, B, or C, or was there significant growth in any of the certain areas?
So in terms of the rate growth, it was pretty even by class of building, although it was significantly stronger in the CBD markets. San Francisco came in as they have been with double-digit rent growth, same with Silicon Valley. But most of the CBD markets were registering in excess of 5% rent growth, while the suburban markets were registering obviously less.
Yeah, that San Francisco market, I mean, that place is on fire, isn't it?
That's right.
I was there and I saw a homeless guy and he had 2 cell phones. So the real story is still in the central business district. Are you seeing some suburban growth as well?
Still, we are still getting good absorption coming out of the suburban markets. It's just not the rent growth. Mm-hmm. But the other big trend that we see is this flight to quality. This flight to quality it spans all locations, both CBD, suburban, class. It's really the Class A stuff. The Class A stuff is generated net absorption rates that are double the rest of the market. So of that 12 million square feet of net absorption, over 8 million square feet was in the Class A segment, well over its fair share. And the flight to quality by tenants to the nice space is clearly there. It suggests that if you have a weaker property, a lower quality property, if you can improve it, you're going to have a better chance of leasing it up.
Right. And is part of that because the economy is improving and companies are feeling more confidence?
I think it's partly that, but I think it's also as people are squeezed into smaller spaces, it's a lot easier to squeeze people into nice space and sell it to your workers than to squeeze them into not so nice space. So I think that's the general trend there.
Well, that's a good point. If I'm going to be squeezed into a closet, I want a Class A closet, right?
Yeah.
Well, what about, you mentioned investment sales and sales in general. So what type of velocity did you see there in the first quarter and kind of the end of last year? And what's the story for cap rates?
Okay, so I think this year is going to be the year of the big deal. All right. For office, we had $33 billion trading hand in the first quarter. For all of last year, we had $100 billion. So this is an exceptional first quarter. Now, some of it may have just been a holdover from the fourth quarter. But we have the likes of Blackstone buying parts of GE. We have other big deals that are in the offing. And so the flow of capital and the sales volumes is likely to be very, very strong. In terms of cap rates, the cap rates continue to slightly compress, but not like they were in a year ago. We're still seeing a very wide spread in the cap rate between CBD and suburban markets. In fact, the pricing spread based on cap rate is like paying a 25% premium for CBD for the income stream that you get off of it. So it is a very significant trend there.
And what are some sample different cap rates for suburban versus CBD?
So many CBDs are coming in at about a 5.5, closer to 7 for suburban cap rates.
Wow. That is a big difference. So what do you expect, Walter, moving forward in the U.S. for occupancy and rates moving forward in 2015? Are we going to see companies continue to lease more Class A space? Are we going to have better absorption, better occupancy?
Okay, so for this year, we expect vacancy rates, which are 11.3 right now, to decline to about 11%. So last year they declined 70 basis points. This year we're looking for only 30 basis points of decline. We're looking for rent growth in the, let's say, 3.2 to 3.5% range, which is very similar to what we achieved last year. We're looking for net absorption in the 80 to 90 million square feet number, which is very similar to last year, and about 60 to 70 million square feet of completions. All in all, pretty good market, but clearly the construction pipeline is picking up, and so the rate of recovery in terms of occupancy is slowing.
Okay, and we're talking with Walter Page with CoStar about the U.S. office market. And Walter, if vacancy is 11.3 now, you expect it to go to 11, how does that compare with historic vacancies for this sector in the U.S.? Where are we today in comparison to historic numbers?
Okay, so the long-term average is 11.2.
11.2. Okay.
So we are right there. And that's the reason why it feels like a normal market right now. If you were out there, you can look at the level of construction today. We're at 108 million square feet. The normal long-term average is 120 million square feet. The rent growth number that we're talking about in the threes is a little bit above inflation, more than normal for office, which is closer to, let's say, inflation, so 2.5. But we are very much in a normal market.
That's great. So we're starting to see rental rates get to a number in many markets that justifies new supply?
Yes, about a third of the markets justify new construction now. Mm-hmm. Now, those are the markets that have had the greatest rent growth. So at the top of the list is some of the technology markets and energy markets. So San Francisco, San Jose, Houston, those are the markets that have the most construction. In contrast, some of the housing bust markets still don't have rents that support new construction. Best examples of that is Orange County, Atlanta. It's not widespread in terms of construction, and the same is true of many of the Florida markets.
Okay. Another one of the numbers that you guys track, I think, is interesting are the repeat sales trends. What do you see there in the office sector?
Okay, so repeat sales trends have actually slowed. We're seeing about a 4.5% repeat sales rate of increase on a nationwide basis. That's down from the 7 to 8% range a year earlier. So we're still seeing significant appreciation and things like that, but it is slowing from where it was. So the crush of capital appears to be easing to some extent.
Okay. And where do you believe there's some opportunities for investors in the office sector?
So some of the best opportunities in my mind are fixing properties. And some of the largest sales that actually happened over the past quarter involved fixing properties. The best example is Blackstone sold a building for near record pricing in Midtown Bryant Park, about $1,800 a square foot.
Wow.
That building was bought by Equity Office when I was at Equity Office for $420 a square foot.
Nice.
Now, then that building was reskinned and obviously re-tenanted, and they have been able to, reap big rewards.
That's fantastic. Walter, thanks for joining us today. We appreciate you being on Skype with us.
Thank you.
Stay tuned for more on the office market. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Bull Realty Commercial Advisors, a great place to do business. Visit bullrealty.com. RealNex, a comprehensive and powerful suite of commercial real estate tools at an incredibly low price. Visit realnex.com. That's RealNex. Xceligent, the resource professionals use for commercial real estate information. Visit xceligent.com. That's XCELIGENT. Commercial Search, the source to market and source available properties for sale or lease. Visit commercialsearch.com. For more information on these great companies or for additional videos, podcasts, or articles, visit CREshow.com.